Hi folks, Nick here, recapping the week ending 4/3. It's a short week. It's Friday. The markets are closed, so the scoreboard is as of Thursday trade. The Dow on Thursday was up 0.37%. The SPX was about the same. NDX lagged a little bit, only up 0.11%. The small caps were in line with the Dow and the SPX, up 0.32%. However, small caps have been leading up and waiting closest to their recent all-time highs. They threatened to break out all week long and last week. However, the broader indices did not play game and did not join it. So on Friday, it said, you know what? I'm going to let go too, and they stopped leading. That was a market change for me. I did not like that. So I will monitor that on Monday to see if indeed the behavior has changed. What also has changed is between Thursday close and Friday open, even though there wasn't an open, we still had the NFP, the jobs report from the government in the U.S. And the report shocked many. It came out, the expectations were 240,000 jobs. We had 127, I believe. Now that all by itself is a scary number. However, you have to keep in mind that we've had good numbers. So if you average out the first 3 months, we're still better. We're only weaker than last year, better than any other year past that in recent history. So not a disaster. However, it was received as a disaster. And besides, we had some giant revisions up and down. So I have really no faith in the numbers that they provide. Almost no faith. I mean, these fluctuations are suspect at best. If it weren't for the oil sector, the oil sector had been offering a lot of jobs. You heard of cities coming up in the U.S. To feed this fuel frenzy, so to speak. And maybe outflows from that are now being read and measured. So one number, and I don't think it will change Yellen's mind as far as rate hike for 2015. I think it's a done deal for 2015, even if CPI is not at target. She said so. And so traders have to get used to the idea. So now bad news, like this jobs number, is most likely perceived as bad and not good news, because they probably resolved themselves that she's going to raise rates in 2015. Okay, so let's look at the trends. Trends are not looking good. This morning's reaction, you can see it right here. The markets hated it, and we dropped probably almost 30 points on the S&P. We dropped quite a bit on the NASDAQ. That's the S&P, that's the NASDAQ minis, and these are the small caps. The change I meant is, look at this. We had higher low, higher low, higher low, higher low, knocking on highs, recent highs. These are all-time highs up here. So we're still pretty good shape. In fact, the small caps ended the week green, as opposed to the other indices were red. Something to note. So higher low, higher low, higher low, higher low. Guess what? This morning they broke that trend, the green line. They're down here. If that's the case, sometimes they overshoot, and 1220, maybe 1210 might be in line for next week. I will keep that in mind before I commit to any more longs. So in summary, the portfolios that are long only, caution is well warranted, and balance is necessary at this point. How do I balance? I either take some short positions, however, it may be too late right here, or not as safe as, say, taking some defensive position, meaning you can buy calls on the VIX because the VIX spikes up in disaster times. I don't particularly like that. Or you can straight out defend the ticker you're trading by buying puts in that ticker. You can do it in the indices, SPX, SPY, NDX, triple Qs, IWM, whatever you want. Or you can even use the crazy inverse ETFs that are leveraged. So like, for example, the TZA moves 3 times in the opposite direction of the small caps. There are many out there, so do your research. Here's the TZA. And on bad days, like this day, that was a bad day for the market. I believe the small caps were down 2%. It probably shot up closer to 6% because it shoots up 3 times. So down 1% for the market, it will be up 3%. Make sense? That's the 3 times inverse ETF. This is money wasted, but it's like buying insurance on your house, on your car, on yourself. You know you're going to waste a lot of premium, but you can't go without it. You can't buy it after you get hurt, after your house burns down. They won't sell you the insurance on the house. I know you've heard it before, but it's money wasted on defense. Now, if I threw away a couple $100 to protect a $10,000 account, or I threw away $1,000 to protect a $100,000 account, or I threw away $10,000 to protect a $1 million account, it's nothing. That money I, quote, threw away allowed me to stay in my positions that ended up to be profitable anyway. Otherwise, I'm just being reckless. Stuff happens. Trust me. Out of the blue, it happens. I'm not calling for it, but if you don't buy insurance when you're seeing smoke, when do you buy insurance? And we're seeing smoke. This is the VIX. You can see how it spikes, okay? You can say, oh my gosh, it's so high. It's not high. Let me remind you how high it can get. Look at this number right here. What is that? 90? Okay. So mind you, this was a debacle. But we've had spikes to 40, 50. Recent ones, this is 2012 right here. This is funky, whatever this is, 30 on 14 October. So that was a correction in October, sent it to 30. So it is a viable method to protect yourself for the spikes. So or downturns in the markets, there'll be spikes in here. Okay, so there are many ways you can defend your portfolio, and I would do that. You can also pick on some wounded gazelles like Netflix and Amazon are my best right now because they have big gaps here, right? See the big gaps right there? Those are voids that are likely to be filled faster than normal tickers, say Apple, which has a good following, and it's perceived as safe haven. So Apple's downside may be here, whereas Amazon's and Netflix is miles away. So what happened this morning, Friday's morning, is something to be paid attention to. As far as variables, we still have the same variables. Political, danger in the Middle East. Economy, U.S., uh-oh. One report doesn't make a trend, but uh-oh. China, bigger uh-oh. They talked like Draghi. We're ready to do anything, quote, almost, like Draghi style, talking up the growth targets. They want to meet their growth targets. That's another, what are they seeing? That scares me. Rate hike, it's coming in 2015. It will take a miracle for her not to do it in 2015. Currencies all over the map. Dollar is weak last couple of days, especially this morning. EQE, the QE in Europe, data dependent. So there, bad news is good news. Good news should be bad news because it's data dependent, quote, right? So you want bad data for them to continue it aggressively. Oil, nobody knows what's going on. Do we have a deal? Do we not have a deal? Nobody knows. So up in the air for now. Bonds and rates, they're no longer driving markets. They're interesting to watch here and there. So the ranges are looking a little scary. I'll show you the charts. This is the IWM holding up the best so far. I don't want to see it break this higher lows, and now what? Okay, so this is pretty dangerous right here. All right, so next weekly candle is pretty important. It's good that it's a green candle, right? So let's go see the SPY. We can't measure the volume because we were missing one day, so the volume, let's call it in line with last week's. Okay, 2 red candles in a row. Look at this, knocking on the lower end of this trend. Losing this one would be, 205 is pretty important for them to hold. If not, they might overshoot. Lower highs, knocking on the level. If the bulls get tired, they might overshoot down to 200, say, which is about SPX 2000, just roughly. The Qs would be the NASDAQ. Holding up in the middle of an ascending channel right there as opposed to a rising wedge. Higher lows, that's pretty good. They're maintaining that at least to some degree. That's pretty good. And as far as the lower highs, 2 red candles worry me a little bit, especially because if you look at it on the daily, I bet you it'll show a better picture of that. The daily, and let me zoom into 6 months. The meeting of the levels. This is one level, and this is another level. That box that I drew was resistance, broke out, support. So now the 2 levels meet up in the doji. Doji is an indecisive candle. I don't know what to do. They opened here, they tried to run it, they tried to sell it, they closed it exactly where they opened, so they didn't know what to do with it. Talk about a decision to be made. And we've got a range that's tightened up into a point. Energy's built up, breakout to revisit the high, or break down to test some lows. We do have support levels here, so I'm not too concerned about it, but it is, as far as disaster, all the way down here, like the October correction. But it is, smoke. Like I said, it's smoke. Plus, this high is way worse than this high, which is just about equal to this high, so are the bulls getting tired? So a lot to chew on. But all point to caution is warranted, period. I've been saying it for a while. The setup for next week is just like this week. We had a magnet at 2050. We had a wishy-washy area at this 2075, 2080, 2100 was the start of support resistance. 2050 had support. If it failed, it had backup support, especially around the 2020 area. 2000 should be support. We had more in 1975 and 1950. So we have support, but you got to contain the panic. We have plenty of tickers to watch. This is an important one. Keep on your radar. Do your own homework on it. The IYT, those are the transports. Look at the 2-year trend. Ascending, nice channel. Last 6 months, flat. And look at where they meet. Like the triple Qs, both supports meet up where? Right here. And that is one ugly candle. You open here, you try to run it, and you close at the low of the day. No bueno. So caution is warranted. More smoke. All right, Nick signing out.